Indian households' gold holdings stand at 3.8 trillion US dollars. That's nearly 3 times more than equity. With gold prices over 60% in this year, the FOMO, or fear of missing out, amongst investors is real. So, how should an investor look at allocating the portfolio towards it? And will it drive a consumption boom through the wealth effect?
So today, India is the second largest consumer of gold in the world, just after China, contributing to nearly 26% of total global demand. But more interestingly, in India, gold is not considered just as a metal. It's form of an insurance or form of a financial security for every household because it's core to their savings. And with the gold prices rallying to its all-time high, I think this has gained even more prominence.
Indian households hold over 3.8 trillion US dollars worth of gold. But we don't see a corresponding spike in consumer spending.
I don't think Indian households would sell generations of wealth that they've accumulated through gold purchases into discretionary items like these. So Aishwarya, if I were to ask you, which is the country that's buying the maximum amount of gold in the last quarter? I'm sure you won't be able to guess it. The answer is Kazakhstan, followed by Brazil and Turkey.
Market Talibas brought to you by Sundaram Alternates.
Welcome to another episode of Market Talibas, where sharp minds decode sharp moves. I'm your host, Aishwarya, and today we're unpacking one of the most discussed topics between investors and fund managers, the rally in gold. Is it FOMO or is it fundamentals? Indian households' gold holdings stand at 3.8 trillion US dollars. That's nearly 3 times more than equity. With gold prices over 60% in this year, the FOMO, or fear of missing out, amongst investors is real. So, how should an investor look at allocating the portfolio towards it? And will it drive a consumption boom through the wealth effect? To discuss this, we're joined by Mr. Sandeep Tulsiyan, the fund manager of AIF at Sundaram Alternates. Mr. Sandeep Tulsiyan is a seasoned investment professional with over 17 years of experience in equity research and portfolio management, known for his analytical depth and sectoral expertise. So, Mr. Sandeep, welcome to the show. Let's get started.
Thank you so much, Aishwarya.
All right. So, my first question for you. We've seen gold rallies followed by long periods of stagnation. What are the biggest mistakes investors made in past cycles? And how can investors adopt a more disciplined approach to avoid repeating those costly errors while navigating gold's parabolic behavior?
Very interesting. So today, India is the second largest consumer of gold in the world, just after China, contributing to nearly 26% of total global demand. But more interestingly, in India, gold is not considered just as a metal. It's form of an insurance or form of a financial security for every household because it's core to their savings. And with the gold prices rallying to its all-time high, I think this has gained even more prominence to the critical part of a Indian household's overall wealth and income, I would say. So before taking a decision to invest into gold, let's look at the past and what we can learn from it. See, gold rallies have historically been parabolic in nature. They've seen significant rise and an extended period of consolidation right after that. So when we actually decoded the data over last, let's say 50 or 60 years, how gold prices have behaved, we saw an interesting pattern. There have been three major periods in which you can divide this entire gold rally. One is right after 1970s. Why 1970? Because the President Nixon actually delinked gold from currency or the dollar printing that US used to do in early 1970s. And after that, we saw a very sharp increase of roughly about 8 times in the price of gold. This in the later part of the decade was followed by very high inflation. So overall, in the decade of 70s, you actually saw a gold price rally of 15 times. Of course, many investors were drawn to this sharp rise in gold and were allocating a lot of income to that. But guess what? For the next 30 years after that, gold prices were nearly stagnant. They did not make any money. So there was a very long period of stagnation. The second period is right after the dot-com bust in 1999 2000. In that decade, again, you saw a very sharp increase in the price of gold. But after the Eurozone crisis in 2011, we again saw a very sharp correction because it was followed by taper tantrum, and dollar printing was controlled by US at that point in time. So dollar strengthened, and you saw a 40% correction in gold price after 2011. So again, the investors who jumped in at the peak saw their savings actually devalue. And very recently, even after pandemic, although currently gold prices are at an all-time high, but not just a few years back, right after 2020 to the next 3 years, you saw that the gold price had corrected globally. So the essential learning that one has from here is the importance of asset allocation in a disciplined way and not get driven by momentum rallies. So that's the lesson I think I would gain from history, and advise that to investors.
All right. Thank you so much for sharing. Um, so, central banks are buying gold aggressively, while at the same time, geopolitical tensions as well as lower interest rates seem to be fueling the rise in gold. So, in your view, how much of this rally is driven by fear versus fundamentals?
Very interesting. So, before we dive into that, let's understand first how the gold demand is broken up into different buckets. Firstly, jewelry demand, which is for everyday consumption and personal use, that constitutes the largest bucket of gold demand. That's nearly 45%. This is followed by roughly 25% of demand by investments, mainly when you buy gold bars or you purchase digital gold, that's ETFs or sovereign gold bonds, that constitutes another 25%. And the third piece, which is what you highlighted, the purchases by central banks, this has been on a rise. This used to not constitute more than 10 or 15% of overall demand, let's say 6, 7 years ago. But today it's constituting roughly 25% of overall demand. So definitely there has been increase in this particular piece of demand as well. So firstly, let's look at the jewelry demand. I think with the current gold price rally, these prices have been on a tear, and on an absolute tonnage basis, the jewelry demand has either been slow or it has been going down. And this is largely being driven by two major markets, that is India and China, because they constitute more than 50% of total global demand. Also, the investment demand, that is into ETFs, bars, coins, etc., it had been a dominant piece of the overall gold rally. So when you look at India, essentially the wedding related purchases or festival related purchases for jewelry has actually cooled down. Similarly, in China, there's been an economic slowdown. Even the consumer sentiment has been quite weak. Very recently, the government has made a tax change due to which there is a 7% increase in the price of gold because you would not be able to claim VAT refund on gold bought for personal use. So, for end consumer, this is a dampener in terms of buying more gold. So, definitely, jewelry demand or personal use demand has been weak. When we look at the second bucket, that is the aggressive buying by central banks. Now, this, just to give you context, about $27 trillion is the total market capitalization of gold globally. Nearly one fifth of this is held by central banks. And in the last 5 years, a bulk of purchases are being done by emerging market central banks like India, China, etc. Today, if you look at the total gold reserves of India, it's about 15% of overall central bank reserves, while the number for China is at roughly 8%. So, definitely, there is scope to increase these holdings in gold by a massive percentage. So, that will continue to drive demand for gold. But it's not just India and China, these are also other emerging market economies who are buying a lot of gold. So, Ashwin, if I were to ask you, which is the country that's buying the maximum amount of gold in the last quarter? I'm sure you won't be able to guess it. The answer is Kazakhstan, followed by Brazil and Turkey, and even a country called Guatemala. So, can you imagine these smaller countries, which are part of, let's say, the developing economies, are buying a lot of gold, which has historically not been the case. So, in my view, I think this will form a sort of floor price for gold. And when we look at the third bucket, that's investments, I think that has also been on a rise. It's contributing today. It was contributing last year, roughly about 25% of overall demand. But in the current year, the investments piece is contributing roughly to the 40% of overall demand for gold in tonnage terms. If you look at total investments done by Indian mutual funds today in gold and silver, that's crossed roughly 1 lakh crore mark, which is significantly higher. And if you look at the overall investments on a monthly basis, that's seen a 12 times increase by ETS into gold. So the demand is quite high. So the natural question is, why is this happening? I would see two major reasons. First, there's a lot of geopolitical uncertainty. Between many countries, there have been trade conflicts as well as regional conflicts. And at such points in time in history, usually gold finds itself as a safe haven asset. So that is driving some investor demand towards gold. Secondly, it's the uncertainty on US monetary policy as well as dollar dynamics. See, usually a lot of central bank purchases go into US treasuries. But the way US has been expanding its balance sheet and been printing more and more dollar, some of these treasury investments have actually been moving out of US treasuries into gold. So that has also been driving demand for gold globally. So these are two major reasons. And I think with the kind of uncertain environment we are living in, this is likely to continue.
Very interesting. I did not personally know about Kazakhstan being one of the larger gold investors. I always thought it was India, which actually brings me into my next question. As I mentioned earlier, Indian households hold over 3.8 trillion US dollars worth of gold, but we don't see a corresponding spike in consumer spending. Why do you think that is? Do you think gold can become a source of liquidity for Indian households, or will it just remain reserved for big milestones in life?
Yeah, again, very interesting because a lot of economists as well as I would say media articles have been highlighting how sudden rise in gold value is likely to drive a wealth effect. Now, let me give you my take on that. See, gold is an eternal part of Indian society. It's deeply embedded into Indian households. I mean, not just as an investment, but as a symbol of prosperity and also as a symbol of financial security in times of exigencies or in bad times. Essentially, I would say. So today, Indian households have collectively about 35,000 tons of gold with them. That's roughly about 89% of Indian GDP. And as you also highlighted, that's roughly three times the amount of equity holdings by these households. Now, the paradox is that despite this vast stockpile of gold available into Indian households, we don't see the consumption picking up. And the government actually has to drive consumption through tax breaks. They've done GST cuts, they've done income tax cuts. The government really wants to push consumption. So we also have a very similar view as what the government is having. We don't think just because the gold holdings of Indian households is valued at a higher price, that will drive a wealth effect and drive discretionary spending. No, we don't think it's going to happen. See, jewelry continues to dominate demand. If you look at India's overall demand pattern, two-thirds of gold consumption goes into jewelry. Balance one-third goes into silver coins, bars, and things like that. So out of this, the consumption demand has been shifting over the past 5 years. Today, gold bars, which are 32% of overall demand, used to be roughly about 24% just 5 years ago. That has consistently been increasing. And there are several factors at play. I mean, if you've seen digital platforms who made it easy for any individual to invest into gold today, which is why I think on a monthly basis, roughly $2 billion of investment goes into gold. This number used to be less than $150 million just 2 years back. So there's been a significant increase on that part. Secondly, when you look at the overall gold holding by Indian households, 70% of this holding is with households who have an annual income of 5 lakh rupees or less. And these households, they generally look at gold as a form of financial insurance and security. They don't consider it as a part of their wealth, which they can go out and spend into discretionary items, like everyday items like consumer goods, automobiles, maybe fashion wear or travel. I don't think Indian households would sell generations of wealth that they've accumulated through gold purchases into discretionary items like this. I think they would essentially use it for insurance or against, I would say, exigencies. Typically, liquidation of gold happens only during such events. Another event which could drive selling of gold by Indian households is typically a major life milestone, like buying a big home or funding higher education for your kids, or funding weddings or marriage of your daughter or son or something like that. Is that would propel the Indian households to liquidate their gold holdings and making those purchases. Otherwise, we don't think it's likely to drive consumption or maybe discretionary spends in a material way. So that's the view that we continue to hold.
Equities and gold, they usually move in opposite directions, wouldn't you agree? But lately, they've rallied together. So, can gold and equities complement each other in a portfolio, or are they fundamentally at odds?
So very interesting again, when you look at the gold prices, they've seen a very sharp rally in the current financial year. They've gone up by 60% versus, let's say, a Nifty 50 index, which would have gone up by 8.5% during the same time. So there's been a significant outperformance by gold. And this has definitely triggered a wave of what I would say a FOMO rally between investors. We can see that visible in terms of the ETF investments that are being done every month. It's touching nearly $2 billion, as I mentioned. So it's going to have more allocation towards gold by Indian investors. And when we look at the number of ETF accounts, these accounts have gone up by 50%, which essentially tells you that, going forward also, these kind of investments are more likely to continue. Now, although historically, gold and equities have typically exhibited a negative correlation. Essentially, when one goes up, the other goes down. But in this period, we are seeing a simultaneously rally. So what does that tell you? It tells you that definitely liquidity is high. Money is finding its way into whatever asset class it can find initially. And of course, more liquid asset classes like gold and equities is where this money is getting channeled into. So I would say it is more diversification at play rather than a conventional risk off kind of an environment where you would move away from higher risk assets like equities into low risk assets like gold. So that is definitely not happening. So I'd like to emphasize that gold should be viewed as a strategic diversifier to your portfolio rather than looking at it like a speculative vehicle. I don't think one should consider a higher allocation just to gain from the gold prices. Rather, one should have a disciplined approach in your asset allocation when you consider gold. Its role is fundamentally very different from equities. Gold provides you with insurance, protection, and a balance for your portfolio. While on the other hand, when you look at equities, they generate cash flows. They are a tool for long term wealth creation. So we should treat the asset class for its primary purpose and not get confused between the two. In our experience, we would advise investors to follow few principles while they're making their asset allocation decision towards gold, equity, or any other asset class. Number one is, of course, avoid chasing momentum. Don't get swayed by the sharp uh, price rallies that you see in any particular asset class. Rather, stick to your disciplined asset allocation approach that you have. Secondly, gold, just view it as an insurance or as a protection for your portfolio to give it some balance and not considers speculation in it that you can enter gold with certain percentage of your overall portfolio and over a period of time you can reduce it as you gain from the recent price rally that you see. Definitely should not be done. And thirdly, opportunity cost of gold is very high. It doesn't earn you any interest or any yield. On the other hand, because it doesn't generate any cash flows. On the other hand, when you look at equities, they definitely generate a lot of dividends as well as yield. Even if you invest in fixed income or bonds over equities, that is not the function of gold. So definitely these three principles should be kept in mind while allocating your portfolio towards gold.
So, on this topic of allocation, I'd like to go into more detail about it. So, let's address the key question here. You've emphasized disciplined allocation. Well, what does a smart gold allocation look like for an equity heavy investor? 10%, 20%, 50%? If someone is just starting to diversify into gold, what's a good entry strategy? Lump sum or SIP?
Again, I would like to harp on the same point what I mentioned earlier. An investor, a prudent investor, should consider gold as a form of defense rather than it being a key contributor to their overall annual returns and give it some balance and not look to gain from its speculative move or you know sharp rise that it has seen in a very short period of time. So rather than fueling a wealth effect, I would say we should look at its core function, that is a store of value and a hedge against uncertainty. So investors should stick to this. and not divulge away from their core purpose. I think for our investors, I would say a prudent allocation of anywhere between 5 to 15% of the overall portfolio into gold can be looked at as a reasonable allocation that can give them some diversification benefits as well as some balance. While on the other hand, equities should remain the core primary driver of your long-term wealth creation. While coming to your question whether you should invest in lump sum or SIP mode, I think it would depend on the current financial situation of an investor. I think for investors who have a regular generation or a regular source of income, they should definitely look at the SIP mode. It will give them more discipline and they will not try to time the market here. But with investors who have some spare cash at hand, they can definitely go at a small amount of lump sum one time investment, followed by an SIP kind of a framework to ensure that the weight of gold remains within this 5 to 15% of their overall portfolio over a long time, can continue to buy gold in smaller quantities. So that's my message to investors. Please stay away from speculating in gold and let equity be the core driver of your long term wealth creation.
Thank you so much, Sandeep, for sharing that. This brings us to the end of this episode of Market Calivas. Two key takeaways stand out. First, gold has an important role to play in your portfolio allocation, not just as a trade, but as a strategic diversifier and insurance against uncertainty, typically between a 5 to 15% allocation range. Second, while gold preserves value, equities create it, driving long term growth through earnings, innovation, and compounding. In short, own gold for balance, but rely on equities for progress. A big thank you to Mr. Sandeep Tulsiyan for joining us today and sharing your insights on navigating this phase in the markets. As always, we hope you walk away with perspectives that help you think sharper and invest smarter. Until next time, stay curious, stay invested, and keep watching Market Dalivas, powered by Sundaram Alternates. Thank you.